The income tax planning area covers a number of areas that we had already talked about. In fact, very much like investment analysis, this is one area where everything seems to have either an investment relationship or some kind of income tax relationship. But let's start with the increase in your exemptions that we discussed. Once again, I just want to reiterate that because you've been getting rather large refunds from both your federal and state tax returns, it's important to increase the number of W-4 exemptions from what you currently have it at up to as many as 7 between the two of you, so that way you can pay later and try to receive your more in your in your bi-weekly paychecks, and this will increase your cash flow situation. In order to lower your taxable income but also provide for your medical, dental, and vision expenses, we discussed how you should invest into a medical FSA and put about $39 every pay period, again, bi-weekly, every 2 weeks, to cover your healthcare expenses. And that would be from pre-tax dollars. If you did not use the FSA that's available through your employer, Tyler, but you wanted to itemize these expenses, you would have to actually have more than $12,000, approximately 10% of your adjusted gross income. You'd have to have medical expenses above that before you'd be able to write any of that off. So because that's rather unlikely, the FSA is a very good way for you to go. We also discussed how you should be using the Missouri Municipal Money Market account, which pays a very good after-tax yield of around 3.286% on a taxable equivalent basis. So that is definitely something to consider investing into. And we also discussed about moving out of some of your lesser performing funds that are held in non-retirement accounts that are held jointly by you two, such as the Kanza, Sagebrush, and Root funds, and then possibly reinvesting those monies into the better performing Haley Growth and Income Fund. Of course, we will do that when you have those assets have been held for 1 year or more and can get long-term capital gains treatment, which is at a 15% rate based upon your tax bracket versus an ordinary marginal income tax that you two are currently experiencing of around 30%. And then concerning your retirement plan contributions, we would like both of you to increase your retirement plan contributions into your 401ks. For Tyler, you're currently putting in around $4,108. We'd like to see you increase that up to $8,000 per year. Mia, you're currently putting in around $3,250. We'd like to see you put in $3,927. Therefore, with those kinds of contributions and the expected returns and strategic allocation that we have laid out for you and will monitor and rebalance for you accordingly, you should be able to retire at age 62 as planned. And then also, to prepare for Becky's college education, we recommend that you invest $3,091 into a Section 529 plan, the Utah plan that we had spoke of earlier, and that you contribute that amount each year for approximately the next 13 years until Becky goes off to college. And in that manner, you should be able to meet up the expenses and have adequate funding for her college education. That money will grow tax deferred and be tax free as long as it's spent for qualified tuition expenses and other college expenses. and at the same time you will be able to get a tax deduction on your Missouri state income tax for those contributions. And then we noticed that the two of you have been giving regularly to your university alumni fund as well as to your church and to United Way. Some things that you may want to consider, especially since you have the assets available, is that if you are to give, you may want to consider giving appreciated stock, bond, or mutual fund investments, because if you were to gift those kinds of assets to a charity, you would be able to avoid capital gains. And likewise, as long as the appreciated property has been held 1 year or more, the donee, the receiver of those assets, will also not be subject to capital gains tax. So it's something to consider doing, and we have included that in your plan going forward.